Hey everyone, welcome back to Corporate Decoder, the place where we decode Wall Street secrets. And today we are diving into a big pharma giant, Eli Lilly Company, and their latest filing, which details a massive bond offering that is going to fund their future. Alright, so Eli Lilly, the makers of popular drugs like Mounjaro and Zepbound, are with a Form 8K, which is a report for special events that could be important to investors. This particular filing is all about a recent big money move they made in the debt markets. Essentially, Eli Lilly needed to raise a ton of cash, and they did it by selling a whole bunch of bonds. Think of selling bonds like borrowing money, but on a much bigger scale and from a lot more people, often institutional investors. The date that this all went down was August 18, 2025. So this is fresh news about how they are financing their operations and growth. This number here, 0000059478, is their company identifier, so you can always find their filings. They are incorporated in Indiana, which is pretty standard for them. And this is their filing number with the Securities and Exchange Commission, or SEC. And this is their tax identification number, the IRS employer identification number. This is just their main address in Indianapolis where all the big decisions happen. Now, critically here are the things they have listed on the stock exchange. We see their common stock, the ticker symbol, of course, is LI. But what's really interesting here are all the different types of bonds they have out there. They have notes maturing in 26 paying 1.625% interest. That's a pretty low interest rate. Notes due in 2030 with 2025% interest. Even lower interest here, tier 0.625% for notes due in 2031. Lilly was really good at locking in low borrowing costs. But look at this, 0.500% notes due in 2033. This tells us that when these bonds were issued, the interest rates in the market were incredibly low. Now we start seeing higher rates. This one is 6.77% for notes due in 26. This reflects a different economic environment when this bond was issued, perhaps when interest rates started to climb, back down to 1.625% for notes due 2043, and 1.700% for notes due 2049, and at even end 1.375% for notes due all the way in 2061. This highlights their strategy of locking in long-term financing at very favorable rates when the opportunity was available, which is smart management. Now let's get to the main event here, the actual deal they announced. This section talks about what's called an underwriting agreement. Eli Lilly signed this agreement with some of the biggest names in investment banking. They acted as the underwriters, which basically means they helped Lilly sell these bonds to the public. Lilly is issuing $750 million worth of floating rate notes due in 28. Floating rate means the interest they pay can change over time, usually tied to a benchmark interest rate like SOFR. They are also issuing $1 billion of 4% notes that mature in 2028. Another $1 billion here in 4.55% notes due in 2032. And a massive $1.25 billion in notes paying 4.9% due in 2035. They are borrowing another $1 billion at 5.55% due in 2055. And a final $1 billion at 5.65% for notes that won't be repaid until 2065. That's a commitment for 40 years. This here tells us how the floating rate notes will be calculated using a benchmark called compounded SOFR. This is the closing date for the offering, August 20, 2025. And how much money did they raise in total? Well, after fees and other costs, they brought in about $6.71 billion. That is a colossal amount of money to raise from selling debt. These bonds are being issued under an indenture, which is the contract between the company and the bondholders outlining all the terms and conditions. And Deutsche Bank is acting as the trustee for these bonds. They make sure the company upholds its end of the deal. This whole offering was registered with the SEC using a Form S3, which is a simpler registration statement for companies that are already public and well-established like Eli Lilly. This language is standard but important. It means if Lilly fails to meet certain obligations, which is highly unlikely for a company of this stature, the entire loan amount could become due immediately. This is a protection for the bondholders. This means Lilly has the option to pay back the bondholders earlier than the maturity date under certain conditions, which is also a common feature for corporate bonds. Finally, we get to the exhibits, which are the actual documents that back up this filing. This is the actual contract with the banks that sold the bonds. This is the original master contract for bond issuance, which is quite old, showing a long history of issuing debt. This is the document that spells out the specific terms for all the fixed rate bonds they just issued, like the interest rates and maturity dates we talked about. And this one is for the floating rate notes. This is a legal opinion from a law firm, likely confirming that everything is in order from a legal standpoint. And this is the law firm's consent to be named in the filing. This is for the electronic filing system, so everything is machine readable. And here we have the signature block. This is signed by John Haug, who is the Senior Vice President Treasurer and Head of Corporate Finance and Investment Banking at Eli Lilly. This confirms the company acknowledges the details of this bond issuance and had the proper authority to execute it. The date of the signature is Wayne Astor's Canty 2025, confirming the official filing TAT. Now, looking at this filing, what does it all mean for Eli Lilly? To raise nearly $7 billion through bonds, it signals a huge need for capital. Companies do this for several reasons: expansion, research and development, acquisitions, or to refinance existing debt. Given Eli Lilly's position in the booming obesity drug market and their investment in new therapies, it's highly likely this money is earmarked for significant growth initiatives. The mix of bonds includes both fixed rate and floating rate debt. The fixed rate bonds, especially those with longer maturities like the 2065 notes, for example, are a way to lock in today's interest costs for a very long time. This is a strong move if they anticipate interest rates will go up in the future. The floating rate note allows them flexibility, but also means their interest payments could increase if benchmark rates rise. A company like Eli Lilly with strong cash flows from its blockbuster drugs should be able to handle variations in interest payments could increase if benchmark rates rise. A company like Eli Lilly with strong cash flows from its blockbuster drugs should be able to handle variations in interest payments could increase if benchmark rates rise. A company like Eli Lilly with strong cash flows from its blockbuster drugs should be able to handle variations in interest payments could increase if benchmark rates rise. A company like Eli Lilly with strong cash flows from its blockbuster drugs should be able to handle variations in interest payments. The fact that they are going to the bond market for such a large sum, rather than, say, issuing more stock, suggests they want to avoid diluting ownership for existing shareholders. Selling bonds is a form of borrowing, and businesses often prefer debt financing when they are confident in their ability to generate enough cash to pay it back, and when it's cheaper than equity financing. The interest rates on some of these new issues, like the 4% and 4.25%, are higher than their older bonds we saw earlier in the filing, but they are still at levels that are manageable for a company with Eli Lilly's financial strength and promising product pipeline. We need to remember that Eli Lilly is in a very exciting phase with drugs like Mounjaro and Zepbound that are not only treating diabetes but also showing significant promise in weight loss. This huge capital infusion likely fuels the massive manufacturing expansion needed to meet the demand for these drugs and to fund the research and development of the next generation of treatments. A potential risk here is interest rate volatility for the floating rate notes and the sheer amount of debt they are taking on. While $6.7 billion is a large number, Eli Lilly has a significant market capitalization and generates substantial revenue and profit. They are also relatively efficient in their operations, as indicated by their ability to secure these varied bond rates from top-tier banks. Overall, Eli Lilly is making a bold move to secure its future growth. They are leveraging the debt markets aggressively to fund what are likely significant strategic investments. This demonstrates confidence from both the company leadership and the financial markets in their long-term prospects, especially in the face of increasing competition and the ever-evolving healthcare landscape. Alright, that's our breakdown of Eli Lilly's latest bond issuance. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord in the description. Thanks for watching. See you next time.